Hello everyone, Landon Jones here from Revisor. We're going to be talking about tax management overlay today. This is a really important topic. Tax management overlay services provided for non-qualified accounts is a very important, meaningful, valuable thing. Significantly reduces tax liability that can be created from trading activity in non-qualified accounts. So, what I'm going to do, I've got a real life scenario. So this is a actual client statement with their information removed, and we've got an actual tax return with their specific information removed. So we're going to do a real life case. This is a actual client of my retail financial planning practice. For those of you that don't know, I'm the founder of Revisor, but I still work with my financial planning clients, not a lot, but 10 to 12 hours a week. For multiple reasons, I enjoy it. It keeps me fresh and involved with what advisors are doing and going through, and we also test all of our processes and products and all of the things that we do and we push out to the advisor world is done and tested on our own planning practice before so. So now I want to cover tax management overlay from a very broad perspective to start, paint a good picture of what it is from a macro standpoint, from a 60,000 foot view, if you will, and then funnel down to more specifics as we move along. So let's start with some important background and let's say important just understanding of what's going on from a very general standpoint. So we got to think about models to begin with. So when you look at an efficient financial planning practice these days, almost everybody's talking about models, having model portfolios, and this causes some folks problems because they need specific things for specific clients, and the model portfolios that either they've created or the TAMP they use has created don't fit what they're looking for. But in general, the models approach is really the only way to have scale in your practice, to create economies of scale in general, and especially scale from a trading standpoint. So to be able to trade all of your accounts at the same time when you rebalance accounts or make swaps of one security for another, the models approach is what allows a firm to do one set of clicks and get all of that trading activity done. So when we look at non-qualified accounts, accounts where we would have tax liability when we trade, capital gain liability, dividend income, interest income, all of the sources of income that flow from taxable or non-qualified accounts, we have to we have to treat them differently if we want the client to be in the most tax efficient position as possible. So that's what we call tax management overlay. Is what do we do? How do we handle these accounts in this scalable models-based trading world? And again, I'm going to use our retail firm, LRJ Wealth Management, as an exact example here. So we've got 15 or 16 client accounts that we have assigned in our rebalancing software as tax management overlay accounts. So when we do what we call a global level trade, and some of this terminology, I want to make sure that I define things that you might not be familiar with. Global level trading or firm level trading is what we would is the terminology we would use for trading all accounts at the same time with one set of clicks. So when doing global level trading, if we just randomly or willy-nilly trade all of our non-qualified accounts, rebalance them, whatever, we could end up with some really significant tax ramifications, negative tax ramifications. So what we do with these tax management overlay accounts is they are removed from the automated trading processes or the global level trading processes. So all other accounts, all smaller non-qualified accounts that are not that we do not, provide this service. All Roth IRAs, traditional IRAs, all of those things. All deferred accounts or qualified accounts are traded. All non-qualified accounts that are not categorized as tax management overlay accounts are traded. They're all done at the same time, 10 clicks, and all said and done. Then we go in on the same day and we review each and every one of the tax management overlay accounts to figure out what it is we're going to do to get the portfolio adjusted. So the best way to really think about this big picture is, you've got this account where there could be some capital gain liability if we just trade it like IRAs and Roth IRAs. So we want to change the portfolio. However, obviously, if we just did trades in all of our other accounts, we most probably want to trade these accounts and update them as well. So when you really look at this, let's say big picture is we want to get the strategy that is, desired with the trading. So it might just be rebalancing. Equities have had a big run up, bonds, have not, and we want to just get the, portfolio back down to its original 60-40 type of split or whatever the case may be. So we got really simple things like that, or you could have some tactical type of trades being done. We want to put a 10% gold position in the portfolio, real estate in the portfolio, a sector specific position, whatever the case may be. Or it might just be swapping out one ETF for another because it's a similar position but lower cost. But whatever the case may be, we've got a reason why we did trades, and we want to get that strategy, if you will, employed in these non-qualified accounts where we provide this tax management overlay service. So that's where the tricky part comes in, because if we just pay no attention to it and come in and start selling things, we'll take a look at this account here. Make this a little bigger. You'll see the unrealized gain or loss number. Harley-Davidson stock, $14,000 gain. Huntington, $8,000 and change. You can see these as we're going along. Progressive, $65,000 and change capital gain. Unrealized at the time. So we haven't sold it, so we have not realized any gains in these positions. And this, by the way, is an SMA account for one of our clients, an SMA that we built for them. There is actually some non-model positions in here, some legacy positions that we locked in our trading software. But this is a equity, high dividend paying equity SMA that we manage and built for this particular client. So as you move along here, you'll see we've got some ETFs. As we get down to the bottom here, as you can see, we've got $300,000 of unrealized gains in all of these positions. So if we randomly sold them all, we would have to pay the 15% long-term capital gain rate on $300,000. That would be a big tax bill for the client. And just a random side note, that is what actually happened to this lady, to this client of mine. She became a client 8 or 9 years ago. Wells Fargo was managing her accounts, IRAs, trust accounts, everything, and they were all in wrap accounts. And so what Wells Fargo was doing was rebalancing all of the accounts as if taxes didn't exist. And so I got introduced to her after this occurred, and she had about $150,000 of gains one year. And that was a combination of gains from barter transactions or sales. There was almost all mutual funds in the account, so there were also capital gain distributions. But the two combined, capital gain distributions and sales or barter transactions, came to a total of about $150,000 of capital gains. So she ended up having her Medicare Part B premiums quadrupled. Social Security benefits ended up at the maximum 85% of those benefits became taxable that year, and just all in all, it was a bad thing. made her, very nice lady by the way, made her very unhappy. So we showed her how we handle these types of issues, and she was obviously very intrigued, and now she's a client. So these things happen in real life where large non-qualified accounts will just randomly get rebalanced or traded as if the tax return is never going to be filed, or as if it doesn't matter, and we obviously know that it does. So what I'm going to do now is get into a little bit more detail and give you a real life example of of how tax management overlay works. And this is, by the way, tax management overlay is a paid for service. It's time consuming. These accounts have to be individually reviewed. So a third party manager like a revisor is going to be charging 6, 8, 10 basis points, somewhere in that ballpark, to provide this service. It's normally passed on to the client. So a lot of advisors, kind of pay their TAMP if they use one out of their fee. If they're charging 1% and the TAMP takes 25 basis points, then they're left with 75. Usually these types of services, they're discussed with the client. Client understands the importance, and in that exact example I just gave, they might increase the client's fee to 1.1%. That way, they're still netting the 75 basis points in that example. So, and it creates a lot more value than 6, 8, or 10 basis points. So it is well worth the cost. We've got some little software systems or little calculators that can actually illustrate the dollar value and or breaking that down into a percentage value. And it is that's a different recording, but it's much higher than between 6 and 10 basis points. So real quick before I go through a detailed example here, I want to mention that we specifically have two different levels of two different types of tax management overlay services. I don't think a lot of third-party managers do this, but it's something that we know is needed because of our specific client base and talking to advisors and listening. So we've got two different models, if you will. So the first, what I would call the, let's say, discretionary model, where you're giving the discretion to us to make all decisions. That these things are always agreed upon between the financial advisor and the end client, obviously. But what that methodology basically says is financial advisor and client say, revisor, we trust that you know what you're doing and that you are looking for the best net return, period. And if that means that I have to, incur $50,000 of capital gains one year or $25,000 in gains, whatever the case may be, that you do whatever you would do for your own account, understanding what the tax ramifications are. And obviously, anytime we trade and create capital gains, it would be because we believe that the future value of that change is much more valuable than the current tax cost. So that's option one. Option two is a more restrictive version and is a little bit more common, is more commonly used. And that's where the financial advisor and the client, basically put constraints in place with us as the third-party manager. And those constraints are very simple. There's a certain percentage, or certain, I should say, dollar amount of capital gains that can be created without contacting or having a conversation with the advisor and client. So, for example, $5,000 in gains is a very commonly, $5,000 and $10,000 are both really commonly chosen options. So, in that example, financial advisor and client say, "Hey, revisor, if anything that you want to do in trading this account, if it creates less than $10,000 in gains in any given year, go ahead and take care of it, no issues. But if it's going to be over $10,000 in gains and you think we should do it, and you would do it for your own account, then there needs to be a conversation with the advisor, or with the advisor and client, whatever is preferred by the advisor." So that, like I said, is the more common version, and just allows there to be some assurance by the end client that there won't be capital gains created above a certain level. Okay, so now let's cover this a specific example here. I'm going to do just one. Typically there's more than one trade that we would want to do in these accounts. So just as an example, if we were rebalancing, if we were trying to rebalance and get back to, let's say equity was originally 60%, so we had a 60-40 portfolio, and then equities run up and bonds don't, and now let's say we're at 70-30. To get back down to 60-40, we've got to sell some equity positions. We would normally sell more than one. So other examples, if we're making changes, tactical changes, and we want to bring a sector-specific position in, real estate, gold, whatever the case may be, a lot of times there's more than one position that we desire to trade to get these accounts, let's say up to date or adjusted and matching the strategy that we want to employ. So I'm just going to show one example, just one trade example, and that will paint the picture of how all this works. And I'll mention here, the purpose of this conversation or this recording is not to give you a step-by-step kind of recipe for exactly how to do tax management overlay. Is to teach you the concept of how it works, why it's valuable, what it does for your client, and so on and so forth. Okay, so let's take an example here. Let me find let's just use this position right here. Or this would be perfect. Okay, let's use this position. We're going to make just a silly assumption here. This PowerShares dividend ETF. We were, let's say, doing our fiduciary due diligence, and we found as a third-party asset manager that there's a position that gives us almost exactly the same exposure, exactly the same portfolio, but it's 10 or 15 basis points lower in cost. So we want to make that what we call a security swap. We want to swap out this Vanguard dividend ETF or whatever it would be and sell this PowerShares position. So we do that in all the other accounts. So we would make that trade in all the IRAs and Roth IRAs and all accounts other than accounts with tax management overlay services attached. And so now it's time, we're going in and we're reviewing this account. We want to get this swap done, and we see that there's $48,000 in unrealized gains. But we really, really want to swap out these positions because it's going to save the client a lot of money and from an expense ratio standpoint. So what tax management overlay is really doing is number one, some of it's just simple operational tactics, if you will, or strategy, which is setting up rebalancing software, trading software, in a way that these accounts are organized and set up in a way that they're not traded globally like all the other accounts are. So that's a real simple thing. You got some operational or administrative things to get in line with software. And then after that comes the expertise. And it really, what it boils down to is trading, is restrictive or smart trading processes. So in this example where we want to get rid of this PowerShares dividend ETF and there's $48,000 in gains, we're going to pop over here to the tax return now. This is actually just the Schedule D from this client of mine's return. Again, the information or specific information removed. This was from 2016. So in 2016, we purposefully created some losses. So you'll see here, there's the total proceeds, there's the cost basis, there's the loss amount, there's the total loss amount, $48,940. Now, this is an important little concept here. So $48,940 is the amount of capital loss carry forward that we have created for this client. And we did that purposefully. So in 2016, we had, these were actually bond positions. and we wanted to create some losses, and we had losses in some bond positions. So we sold those bond positions, and then we bought very similar bond positions back, 5 seconds later. And this is a side note, but so that this all makes sense. Um, that little process is what we would call tax loss harvesting. So most of you have probably heard of tax loss harvesting, and tax loss harvesting is part of the tax management overlay process, is how I would describe it. So obviously tax loss harvesting can be done just kind of on its own, and no other functions, tax planning functions, provided on an investment account. But tax management overlay is, let's say, multiple things, and tax loss harvesting is one of those. So tax loss harvesting, simple concept. The IRS created a rule called the wash sale rule, and it was created because investors would have a loss in a position, let's say Ford stock, whatever. They own Ford stock, it's down 100 grand, they sell the position, create the loss on paper, and then buy it back 10 seconds later. And the IRS says, no, you didn't actually sell the position, you're just trying to create capital losses. So we're not going to allow you to do that. So they create the wash sale rule, which says you have to wait 30 days to buy the position back if you want to take the loss. And in their mind, that's a long enough time. That's a big window of time, and the average investor probably doesn't want to wait that long to buy the position back. So they think that solves the problem. And then there's all of us clever folks, attorneys, financial advisors, CPAs, and the like. And we're always looking for loopholes for these things, right? So what tax loss harvesting really is selling a position and buying a position back 5 seconds later that is almost identical to it, but not the same ticker symbol. And this is one of those things that has, it might go away one of these days. It might not be possible, but it's kind of slipped under the radar. And my firm, we do tax preparation work. We have a kind of a partner CPA firm that we lease space to and do joint work with. And to my knowledge, we don't know of any cases of this process being challenged. But obviously things can change. But as of now, it works. And what it really consists of is, I'll use a real life example, to create the losses that were created on this client's tax return. This is very systematic and very, it's built into our trading software, our technology, where we literally have let's say a on deck position ready. That is, we have an on deck position ready for all of the positions in our models. So just a silly example, we could have an iShares ETF that mimics an index, and then as a on deck position, we could have a Vanguard indexed position that's almost identical, if not identical, but with a different ticker symbol. And so what would happen in tax management overlay accounts, or where we're doing tax loss harvesting, we would see that a position had a loss. So let's say the iShares position they own in the account currently has a loss. We want to sell it and create that loss. We can't buy that exact same iShares position back 5 seconds later. That violates the wash sale rule. So what all these clever folks have come up with is, okay, we'll sell this iShares ETF and buy this Vanguard ETF that's essentially the same thing with a different ticker symbol. And now we've got the loss on paper, and we didn't really change the portfolio. And so for this particular client, we sold some some very broad bond ETF positions, and had the backup position ready to go, and bought it back 5 seconds later. And the result was this almost $50,000 loss. Now, why do we want the loss? We want to be able to use it in the future. So tax loss harvesting is really, it's not just about, if you just try to do everything in 1 year, you go, all right, well, we need to sell some stuff this year. There's going to be gains, so we got to find some losses. Well, if we did that, take a look at this account. Find me the losses here. If we were in a pickle and needed to sell some stuff this year that had significant gains, Here we've got all gains, no losses. This GM position has a very small gain, but it's still not a loss. We've got all gains here. You'd see parentheses if it were a loss. This Sun Life position, it was transferred in with the cost basis unknown, but it's got a very large gain as well. Here we go. We've got $155 loss in this one position right here. And that's the only one. So if we needed to sell some of these positions with gains this year and in 2018, and we had never done, prepared and done what we needed to do in previous years, we wouldn't have any losses to offset the gains that we're going to create. So that give you a nice rounded overview and understanding of how all this comes together. So now let's get back to this specific example. Here's this PowerShares dividend ETF. We're going to sell it and replace it with a almost identical position, a Vanguard dividend ETF. And we go, well, goodness, so there's $48,000 in unrealized gains. So, well, that's okay because we've created $48,000 in losses over here. And this is one important little side note that can make this confusing if you don't understand it. A lot of advisors know the $3,000 rule with capital losses. So they're familiar with the fact that, if you have let's say $100,000 in losses, you can only deduct $3,000 against your ordinary income, your wage income and interest income and all your other income sources. So you're limited to $3,000 of capital losses that can be used to offset ordinary income, but you can indefinitely offset gains with losses. So you could theoretically, if you had $1 million in losses, and by the way, your losses carry forward. So this particular client where we have this 48,000 and change in losses, you can see we use 3,000 of it against ordinary income in this particular tax year. And so that would end up leaving us with $45,940 of loss carry forward to work with. So that's important because it carries forward indefinitely or until death. It carries forward until the taxpayer dies. And in this particular case, we're going to be able to almost completely offset the gains created with losses. So the $3,000 rule only applies if you have losses in excess of gains. So you can completely offset gains first with your losses. And then if you have losses that exceed your gains, then you can only use $3,000 of those losses against your ordinary income. So that being said, we don't have any problem here with offsetting this $48,000 gain. We don't have that $3,000 type of limitation. That only applies for offsetting ordinary income, not capital gains versus losses netting out. So that is how we would handle or what we would do in this particular case. So again, tax management overlay, really, it's a simple concept. There's all these little details. There's all these things that can be done. Asset location or position optimization, which is another recording, is one of the aspects of tax management overlay. Tax loss harvesting is an aspect of tax management overlay. The administrative process of locking the accounts from trading is part of tax management overlay. The process of reviewing those accounts and getting needed trades done without negative tax consequences is part of tax management overlay. So there's all of these interrelated tax planning components that make up what we call overlay. But in this particular example, we made some trades. We changed our models. It was the example I gave here. We updated our model set, and we don't want this PowerShares dividend position anymore. It's too expensive. Vanguard's got an option that's much less expensive. That's what we want to use for our own accounts and for our clients' accounts. And so we want to get that done in this account too. And in order to be able to do that, we have to be able to do these things without creating large capital gains. And I just showed you how that works and how we accomplish it. So that is tax management overlay services in a nutshell. A lot of additional details. We've got other recordings on position optimization and specific recordings on tax loss harvesting. But to give you a nice 60,000 foot view of what tax management overlay is and what type of accounts it applies to, just think non-qualified accounts. We want to trade them and optimize the portfolio results, but we don't want large capital gain liability. And tax management overlay is how I guess you would say people with tax expertise blended with investment expertise, and that's the two needed components to do this. This is a very strong point for Revisor. Myself as the founder, this just happens to be a big part of my background. I built my practice doing tax prep and converting tax preparation clients into financial planning clients. And then I've had a long-term relationship with a CPA firm and lots of interest, research, in doing these things. But that's what's needed in order to get these types of things implemented into a client's account, is a combination of tax expertise and investment and trading expertise. So that's how it all works. If you have any questions, feel free to reach out to us. Visit our website, revisorpartners.com, and look forward to seeing you soon. Bye-bye.